All right, well, welcome everybody to this week's client support webinar. My name is Bennett McDowell, and today, of course, is April 17th, 2024. All right, so I want to go over a couple things today on risk control. I want to cover, before I get going, of course, I want to go over the risks involved in trading, which is a place we always got to start, right? But in addition, if you have any questions, feel free to type those in the questions window, and I will be glad to, of course, answer those. All right, so let me go through some administrational items and cover the risks involved in trading, which is our disclaimer. And we just want you to realize that in the markets we deal in a realm of probability, so there's no guarantee. So risk is a big issue that we have to deal with on each and every trade. And the first thing you want to do is to protect your downside by, of course, using money you can afford to risk, called risk capital. And then, of course, on each trade or investment you make, you want to also calculate what your potential loss could be if the trade fails. And we do that by A, knowing where to put our stop loss exit, which is kind of our price level to get out. But also, two, you need to know if you get out at that price, how much you're going to lose. And that's where, trade size, position size comes into play. And then finally, realize that we're going to be talking about markets and things that may affect you personally, but check with your financial advisor to be sure whatever we discuss here is suitable for you. Like if we recommend a stock or something, or look at something I like, that may not be a good enough reason for you to go into that. You need to check with your financial advisor to be sure it's suitable for you. So that's kind of important. All right, several books are available. I'll put those in the link below on the recording, but also too, you can go to our website as well and check it out. Same thing with our software. Many of you have our software tools. You can always add on, if you don't have them all, you can always add on at a later date, so you can buy them as a bundle, or basically all together, or you can do it a la carte, kind of add them on when you need to. All right, so let's get in and talk a little bit about risk control here. And so I'm going to use a couple of devices here that we have. One is called the risk to reward calculator. I'm going to move this chart over just a little bit like that and bring that into view so you can see it the entire time. All right, so this, I'm just going to use USO as an example here. So let's say we were trading USO and we were going to use the pyramids to enter. So I'm going to calculate the risk on this particular pyramid here. And then we're going to talk about adding into the trend and when that is appropriate, because that can be something that can be extremely profitable on a good trend, provided you do it right. I think that's the important aspect of that. So in terms of the calculations, we use the risk to reward calculator, but if you have the trade size calculator, that's fine as well. So today I'm just going to go over the actual trade size. Next week I'll go over risk reward, but I just want you to get this down because this is really important in order for you to keep your losing trades in line, which is a really important aspect. So I'm going to just put some numbers into the calculator here. First thing you want to do, all right, is change it to stocks. All right, so I had it on futures. So you want to always make sure it's calibrated for the right market. So stocks gets checked there. Let's just put in $100,000 for our account size. How's that? All right, I'll put 100,000, comma 123.00. All right, then the next thing we want to do is calculate the point value, or put in the point value. And we're at 1 here because we're at the stock market. So when you're dealing with futures, the point value becomes really important because, for example, if you're dealing with an E-mini or a micro E-mini on the S&P, the MES, for example, all right, the point value is going to be $5 and the margin is going to be like $350. But for stocks, the point value and even ETFs are always going to be 1. So you only need to worry about putting 1 in for stocks. The margin, however, is a little bit different than what we're talking about for futures. The margin is basically if your stock account is an all cash account or a margin account. So let's say you have a margin account where the brokerage is going to loan you 50% of your value. So you can put 150 in there, all right? If it's a cash account, you put 100 in. So that's how you calibrate that portion of the calculator. Then the rest is basically just putting in the percent risk and the account size, and then the variables we'll go over in just a moment. So account size, we're going to put in 100,000%. Risk, we'll use 2%. So basically, we don't want to lose any more than 2% of the account value, right? So that's really important. All right, so let's go ahead. So let's say, let me just do a couple things. Let me spread this out, and let's just not look at the other pyramids for a minute. Let's say we're thinking about taking this trade if it breaks above the top of this pyramid. So if it goes above the price, then we want to go long here. If it goes below here after we go long, we have to get out, because that's going to be the area where we place our stop. So in terms of the pyramid, the neat thing about the pyramids is that they always point in the direction of the trade. So this is pointing up, so it would be a long trade. And we don't want to take the long trade until we get above the apex or that point of the pyramid. Likewise, if we go long there, we want our stop at the bottom of the pyramid. And this is called the base leg. I'll put BL for short there. And the base leg represents the price bar pullback in this pattern, which would be here. So the other way to look at a pyramid here is that, you know, you start out here with a low one, you move up here with a high one, and you then have a low two if prices move up, and then when it gets above here, you'll have a high two. And the definition of an uptrend is higher highs and higher lows. So that's kind of how the pyramids present themselves. And of course, there's a lot more going into forming these pyramids. We look at the momentum on the different sides of the triangle. So that becomes important as well. But I want to stick with risk control. So we're going to go long here. We're going to have our exit here. So what we do next, and let me just bring this over so we can actually see it. I'm going to bring over the actual data window. So let's have that open here. So if we are getting ready here and we have not yet gone above the pyramid, then we want to get ready and take the trade. So the pyramid will probably be yellow or blue in color, however you have it colored. So we want to see what the high of this price bar is, because we're going to go long on this if it goes one tick higher. So on this price bar, if we look at the data box right below the trade size calculator, we see a high of 69.81. So our entry is going to actually be 69.82, right? So let's go ahead and put that in the entry price right here on the trade size calculator. So we just type that in, 69.82. All right, now let's take a look and see where our potential stop loss is going to be. So the way the pyramids work is if we get stopped out, prices go below that base leg at any time, we have to get out of the market, because that base leg is identifying a key level of support. So we're going to have our stop one tick under the price bar that created that flat line or base leg of the triangle. And that's this one right here. So I'll put my cursor over that one. And the low on that is 66.28, so 66.27. Now, if you wanted to put 66.20, you could do that. If you wanted to give it a little more room, you certainly could do that. But you don't want to have it higher than that, okay? So you want to have it at least 66.27. So for the sake of this example, I'll put 66.27. All right, now I have everything entered that I need to calculate the trade size. So I have the entry price, I have the risk, I have my account size, and I have the exit, potential exit, and the calibration of the calculator, 1 point for the stock, and I'm using a margin account. So everything is entered. That's all you need to enter. We're not talking risk to reward here, just trade size. Next thing you do is just come down and hit calculate, okay? And so now it's telling us on this trade, I can go in with 563 shares, and my risk is 2%. So if I get stopped out, I'm going to lose 2% of $100,000, which is 2,000. So notice the dollar risk is $1,998.65. So in this case here, it's not 2,000, it's just under, because one more share would put it over. So that is what I could potentially lose. Now the cost of the trade is $39,308.66. So let's write that down, $39,308.66. So that's the cost of the trade right there. So now if we go long, we could put a limit order in to fill us at that price of 69.82, right? And that's how that would work. So then we'd be long and our stop would be here. All right, good. All right, so let's see, let's just move the chart a little bit, and we get another pyramid. All right, so in this pyramid here, we simply could take our stop and move it up here. All right, so now if we got stopped out here, we'd even lose a little less than the 1,998.65. All right, hasn't really moved up enough for me to add really any additional shares here, but you know, that's a possibility if you wanted to do that. I usually wait until we're free and clear on the first trade before I add in. So the market moves up again. Oh, and I get another pyramid here. Okay, now where is the stop? Right here, right? On this one. Where did we enter? Down here. So let's draw a couple lines here and really highlight this, because this is kind of important here. So if we grab a horizontal line, we put it at the first pyramid there, notice that the new stop here is above the pyramid, is above the entry. Okay, so what's the risk now once we move our stop from here and then to here, because this is how we trail stops? What's our risk on the first trade? Anybody? Zero, right, good. Dave, excellent. Okay, so, and the reason for that is if we get stopped out here, we get a profit, right? So technically the risk is not there. Now, that's called the trade risk. What's the market risk? What do I mean when I say market risk? Okay, market risk, what that really means is that whenever I have money in the market, it's at risk, okay? And so you have to take that into consideration. I call that market risk. Now, what happens if a terrorist attack came or something bad and the market gapped and opened down here, and I didn't get out until way down here? Well, I'm going to have a losing trade even though I had my stop here. That's market risk. So that's why you always have to fund your account with money you can afford to risk, called risk capital. And traders at the professional level do not trade their entire net worth for that reason. Okay, there's really no way to protect yourself against market risk. The only way is to basically fund your account with risk capital. Okay, so that's really important as well. All right, but this gives us an opportunity here. Now that we have our stop here and we have another pyramid forming, we could go long here, right? So guess what? If I calculate the trade size on this second pyramid, I can add that on and stay in my current position as well. All right, so this allows me to pyramid in or scale in to my trade and to the trend without incurring more than a 2% risk. That's really important, because if I get stopped out here, let's say I go in with a second position here, if I get stopped out here, then I'm going to make a profit on the first trade and I'm going to lose on the second trade. So I'll lose 2% on the second trade, but I'll have no loss from the first trade. So that is basically the proper way to scale into a trend. Therefore, your risk is always kept at least 2%, provided your stop is at least even or above your initial entry. Is that clear? All right, good. All right, now, before we can take the trade on the second pyramid here, or the third pyramid actually, all right, we need to trade size, do the calculations for how many shares again, right? So we need to use the trade size calculator again. But this time, we have to change the account value. Why do we have to change the account value? I always change the account value and subtract out the amount of the cost of the first entry. Okay, because that's now no longer available as cash in the account because that's an equity, right? It's in a trade. So you have to subtract out the 100,000, the 39,368.66 from the 100,000, right? So you have to do that. That's really important. So you just bring up a trade side, bring up a calculator, and you take 100,000 minus 39,308.66. And we now need to enter 60,691.34. So let's enter that now into the account size to reflect the amount of cash that we use for the first entry. That's a vital thing to do. That's really super important because you always are using a cash from the account whenever you make an entry or a trade, right? So you got to subtract that out. And this way it keeps you from over trading. Because if you have a whole bunch of trades, that account size will eventually diminish to a point where you can't take a trade. So it kind of protects you from over trading. All right, so there we have it. Now, what else do we have to do here? Well, we have to re-enter the entry price and the exit price based on this third pyramid, right? So we have to go over here and then use our mouse again. So our entry here is going to be above that particular high on the point of the pyramid, right? So the entry here has a high of 74.05, so it'll be 74.06. So let's enter that in. So we come up here and we put 74.06. Now the exit price is going to be the stop, the base leg of this third triangle, because don't forget, we moved our stops, we trail our stops up. So this is our new stop for everything, okay? So right now our stop here is going to be the low. So this will be the exit. And you want to go one tick under, so it's 71.48, so 71.47. That's where our stop's going to be. So let's enter this as the exit price. Okay, so there we have it. Now we hit calculate again, and now it's telling us we can do 468 shares. But again, you know, our dollar risk on this will be 2% of 60,000. So the dollar risk now is 1,212, not 2,000 like it was before. Okay, and the cost of this trade is 34,660.08, and that is right here. So that's the cost of the trade. This is our dollar risk, and this is the additional new shares. So let's bring our calculator back over here and clear it. So we got what, 563 shares on the first entry, and now we have an additional what, 468 shares, right? So now we have a total of 1,031 shares. But the beautiful thing is that the risk did not increase, even though we were able to increase the number of shares. And that's paramount. Okay, that's really key. So most people, what they do when they add in, they usually dollar cost average in. But the problem with doing that is usually the market is below the stop loss of the first entry, so it increases, right? So you got to be careful about that. So the risk increases. All right, so this market moves on and we get more pyramids. Now, as a general rule, if you look in our rules, after we've had 3 pyramids in a row, we usually do not add in again, okay? So the adding in can only be done on the first 3 pyramids. That's important because when we start to get to the 4th and 5th, we're getting into the mature part or extended part of the trend. And the probabilities of a reversal increase dramatically. So you have to be careful with that, okay? You have to be really careful with that. So in this case here, since we trail our stops here, our stop would initially be here, trailed here, goes here, and now it's sitting here, but we got one more, so it's sitting here. So if we get stopped out here, all right, we will make a profit on both the initial trade and the add-in. Because in this case here, our stop will be off this little pyramid over here. And that's above the entry on the 3rd pyramid and above the entry here. So we would make a profit on both entries. And that way we made more money than if we had just taken an entry off the first pyramid. So there is benefits to adding into a trend as long as you can do it early enough within the first 3 pyramids, and also do it in a way in which your risk never exceeds the initial 2% you were willing to risk on the trade to begin with. That's the way you do it, okay? And it really can do a great job for you. Now, pros and cons, well, those are the pros. The cons is if we had gone in and we got stopped out here, okay, we would have lost 2% and gained a little bit here, so the trade actually still would have been slightly at a loss. So anytime you pyramid in, you have the chance of taking a loss, even though the initial trade may be profitable, but the loss will never exceed 2%. So there's always pros and cons, but it's a great strategy if you think you're getting into a good significant trend early enough to really compound your gains. Any questions on that? Any questions on that? And next week, what we're going to do is cover the risk to reward part of the calculator, because that sets us up between really knowing what trades can give us the type of returns to really get the gains we're after. All right, so that's kind of what I wanted to cover today in terms of instruction. So really, calculate your trade size on every trade. I can't emphasize that enough because it is a vital element in being successful. You know, you can have great entries, you can have great exits, you can have all that really hammered down, but risk control is really the final element that you have to, or really the initial element that you should program into your trading rules in order to keep your losses as small as possible, all right, and let your winners run. Because again, that's the whole point of good risk control. Because you're not going to win every trade, all right? It's just, it's impossible. You're going to lose probably 3 or 4 trades out of every 10. So if you can keep the losses small on those, then you'll still be a net winner. And a 60% trading system can generate huge profits. If you get really strict on your entries and make it 70%, then of course that goes up even more, provided you're using good risk control. All right, so it's really important part of the trading pie, so to speak, to be successful in this business. All right, well, I see no questions coming in outside what we've talked about here. So I'll go ahead and end here. Great session. I think it's important. I thank you guys for your feedback. And we'll be back here next week, basically on Wednesday at the same time. And again, if you have any questions in between, you can always fill out a ticket at traderscoach.com or hold your question and bring it here for me. All right. So listen, have a great week. Like I always say, use risk control, and now you know why. All right. Thanks, everybody. Have a good one.